Welcome back, guys. Today we're going to take a look at Draftkings. One of the subscribers requested it, so here we go. They have come under recent pressure over the past month, so maybe it is a buying opportunity. But the past 5 years have been very up and down. It's been boom and bust because back here when everybody was locked inside and people are doing online sports betting, so up during the clown market, and then they crashed hard for basically I don't really know what reason. Like their margins were improving, their revenue was improving, and yet they just dumped really hard. It's probably just psychology or something. But since then, they have made a massive comeback. So if you would have bought them at $12 a share, you would have made 3x. So pretty good performance since 2023. But let's see if that can continue. Their market cap is 17 billion, pretty sizable company, especially for an online gambling site. And they don't make any money right now because they actually lose money because they spend a lot on marketing. Their financials here, their revenue growth has been stellar. 90%, 100%, 70%, 60%. Moving forward, it's tough to say that it's going to be 50% again, but it's definitely going to be strong growth. Yeah, the first quarter of 2024 it was 50%. I'd probably expect more like 40% moving forward into next year, and then after that, probably lower than that. But yeah, very, very strong revenue growth. And the good thing about this is that their gross margin stays very consistent. And then their operating expenses actually have stayed flat. So as long as they can get their revenue higher and their operating expenses stay flat, then they're going to have positive margin very soon in the coming years. Because see, they lost 1.5, then they lost 750. Maybe next year they only lose 200. Then maybe the year after that, then they're positive already. So it probably will only take 2 years for them to become profitable. And they'll probably have a pretty sizable share jump when that happens. In terms of, they have issued some stock. I think they have been doing some mergers or acquisitions of different businesses because that's not from stock-based compensation. They don't really do any of that. And they buy back some stock. So I think that's from mergers. In terms of their balance sheet, they do have 1.35 billion in total debt, but their net debt's quite low actually. 139 million in net debt, so it's not bad. Cash flow, what are they doing with their cash? Well, they actually just buy back some stock, even though they're losing money. So kind of interesting that they're buying back some stock. Let's look at the stats, look at their margins. Like I said, their gross margin stays pretty consistent. Look at this, 38%, 33%, 38, 39. So maybe next year 40, 41 maybe. Soon enough, and then the net margin has been improving every single year. So I expect this to become profitable pretty soon with revenue growth and gross margin staying very consistent. Taking a look at the investor slides, I wanted to check a few things. So which one should we look at first? Well, let's look at the stock-based compensation. They don't really do any stock-based compensation. You can see that. And what I wanted to see is how much are they spending on marketing. So their marketing expense is $1.2 billion. And when you come back to here, there's statements. $1.2 billion out of this 2.1 billion is marketing expenses. So most likely this is going to stay pretty consistent. Maybe they'll do less marketing in the future. It depends how much they want their growth to be, but I would expect this to stay very consistent. And so that's why I do think that their margins are going to expand when their revenue expands. Then we look at this, and why are they diluting shares? Well, it could possibly be because of warrants. They have some warrants, and they have some vested stock options that are supposed to come out. So pretty soon their shares outstanding is going to increase to 494,000, or maybe like a 4% increase in their share count. And then, yeah, their monthly unique players has gone up from 2.8 to 3.4 million, and the revenue per user has gone up to $114 versus 92. So I do think that this is a growing industry. Now, I know it's illegal in most states, but maybe it becomes legalized in some states. And I just know that it's very addicting. Like, definitely a lot of people get addicted to this stuff. So probably expect this to grow pretty consistently into the future. Let's look at short percentage. Yeah, I couldn't find what the analysts think. I'm going off of the TradingView analysts, but I found their short percentage at 3.6%. That's actually not bad, especially for a company that's losing money right now. 3.6%. I mean, it's decently high, but it's not above 5. So I think that's a green flag for this company. And taking a look at, we could take a look at insiders, I guess. Well, most insiders have been selling. They didn't sell during 2022, but they sold a bit during 2023. Yeah, just a bit. And their insider ownership percentage is quite high at 48%. So I mean, it makes sense that some would be selling. Let's look at the DCF model. So we're going to ignore the earnings model because they don't have any earnings. So we're going to use the revenue and margins model instead. I have their revenue estimate at 4.9 billion. I think that's reasonable. That's what the TradingView analysts have, and net debt of 139 million. Discount rates of 10% because I want a 10% return on all my stocks, and an exit multiple of 25. I think that if they become profitable and they have expanding margins and they have growth of 10%, I don't see why it would not justify an exit multiple of 25. So it's a bit high, but I think it makes a lot of sense. And in terms of what they're going to do, well, they're probably going to not make any money this year. I have them at a negative 5% profit margin this year. And then next year, I think that they're going to be pretty much even. And then after that, they'll probably grow their profit margin by 3% a year, up to 10, and then 12, 15, depending on their revenue growth. And look at this, revenue growth of 18%. Can they do that this year? I mean, they're on track to do 50%, so I think that this is quite reasonable. Maybe their growth here is more like 30%, which actually makes way more sense, right? 30% instead of 18, and then probably even more here as well. Like, just based on their historical performance, I would expect that their revenue growth would be quite strong. But we'll just say that it's 18, and let's say that this scenario plays out where they can get their margins up to 15%. Now, it's definitely possible they don't quite get up to 15% either. Maybe they stay at 10%. 10%, then we could see that they are a little bit overpriced. But I think that's like a worst case scenario pretty much. I think that they are going to get up to 15% at some point. And in that case, they're worth $45 a share. Definitely not a bad company. Now, the thing about it is, I don't really know what makes this company different from other sports betting companies. There's a lot of them out there, and people could just go to different sports betting apps. That's what marketing has to do. That's what marketing does. It draws people into the app and gets them using it. So, not quite sure if this company has a large moat or not. Right? There's not really networking effects. There's competition with other brands. Like, it's not that hard to make your own sports betting company. Like, that's the one thing that makes it tough for me. But based on their historical performance, I do think that their future is bright. So yeah, that's what I think. Let me know what you guys think in the comments, and make sure to hit that like button. Peace.